Ever wondered why December might not be the right time to trade Forex and stocks? Well, let's dive into this fascinating conundrum. You see, timing is everything in the world of trading. Just as surfers ride the waves, traders ride the financial tides. And sometimes the tide is not in our favor. December, often hailed as a month of joy and merriment, might not bring the same cheer in the trading market. Could it be the holiday spirit dampening the trading fervor? Or perhaps the year-end financial decisions playing spoilsport? Or maybe, just maybe, there's a myth lurking in the shadows that we need to bust. The reasons are manifold and intriguing, quintessential pieces of a puzzle that we're about to solve. So buckle up as we embark on this journey to decipher the enigma that is December trading. Stay tuned as we unravel the mystery behind the December trading slump. First off, let's dive into the past. History, after all, tends to repeat itself. Buckle up as we take a trip down memory lane to explore the historical performance of stocks and Forex in December. Now, you may be thinking, isn't December the season of giving? Well, sadly, that generosity doesn't seem to extend to the trading markets. Let's start with the stock market. A look at the historical data paints a rather gloomy picture for December. Over the past several decades, the average returns for major stock indices in December have consistently been lower than those of other months. In fact, some years have seen returns dip into the negatives. That's right, the jolly month of December has often left traders with less to cheer about. And it's not just stocks that take a hit. The Forex market also tends to follow a similar trend. The volatility, which is the lifeblood for Forex traders, often dries up during December. This lack of volatility can lead to fewer opportunities for profit. In fact, historical data shows that currency pairs often move less in December than in any other month. This could mean that your chances of making a profit are lower than usual. But why does this happen? Well, there are a few reasons. One is that many traders and investors take time off during the holidays, leading to lower trading volumes. Another reason is year-end financial decisions, which we'll discuss more in a later section. But for now, the takeaway is clear. Whether it's stocks or Forex, December has historically been a tough month for traders. The trends show lower returns and less volatility, both of which can make it harder to turn a profit. So if you're thinking about trading in December, it might be worth considering these historical trends. After all, as the old saying goes, those who do not learn history are doomed to repeat it. As the numbers show, December historically hasn't been kind to traders. You might have heard of the Santa Claus rally. Is it real or just a myth? Let's delve into this intriguing concept that has made its rounds in the financial world. The Santa Claus rally is a term coined by stock market enthusiasts. It's a theory that suggests a surge in the stock market during the last week of December through the first couple of trading days in January. This theory is based on the idea that investors are in a positive mood due to the holiday season, and this jolly sentiment translates into more buying than selling in the market. However, let's be clear, the Santa Claus rally is, at its heart, a seasonal trend, not a hard and fast rule. It's more akin to spotting shapes in the clouds than it is to a reliable strategy for trading. Consider this. A study by the Federal Reserve Bank of New York found that on average, from 1969 to 2011, the S&P 500 index did indeed rise by an average of 1.4% during the last 5 trading days in December and the first 2 in January. But before you start dreaming of sugar plum profits, bear in mind that the same study found that the rest of the year also saw positive returns, meaning the Santa Claus rally is not a unique phenomenon. Moreover, experts like Ryan Dietrich, senior market strategist for LPL Financial, caution against banking on such a trend. Dietrich points out that while the market has performed well in late December historically, there's no guarantee it will do so in any given year. Adding to this, many financial analysts argue that the Santa Claus rally can be attributed to other factors, such as tax considerations and window dressing by fund managers. Hence, attributing this rally solely to holiday cheer could be a bit naive. So as we pull back the curtain on the Santa Claus rally, it becomes clear that it's more myth than reality. It's a charming piece of stock market folklore, but not a strategy to stake your investments on. So, betting on Santa to boost your stocks might leave you with an empty stocking. Scene script. Holiday season means holiday distractions, and that's our next reason. The festive season, with its twinkling lights and jingle bells, brings with it a whirlwind of distractions. These distractions can divert even the most dedicated traders' attention from the markets. The turkey needs basting, the tree needs decorating, and the children need entertaining. The list is endless. So, what happens when we're distracted? Well, the quality of our analysis and decision-making tends to take a hit. As traders, we rely on focused attention to spot trends, analyze market conditions, and make well-informed decisions. But when our attention is split between the trading charts and the holiday festivities, it's all too easy to miss that crucial market signal or to rush into a trade without thoroughly considering it. This could lead to less than optimal trades or even losses. Now let's not forget that it's not just us who are distracted. The pros on Wall Street and in the City of London are also taking time off to enjoy the holidays. The market activity tends to slow down, with fewer trades being made and fewer news events to trigger market movements. This reduced activity can lead to lower liquidity, which means that even small trades can have a bigger impact on market prices. This might sound like a good thing at first, but remember, lower liquidity can also mean higher volatility, and higher volatility can lead to larger price swings, which can be hard to predict and manage, especially if you're not dedicating your full attention to the markets. So, while the holiday season is a time of joy and celebration, it's also a time when the usual rhythm of the markets can be disrupted. As traders, we need to be aware of these disruptions and adjust our strategies accordingly. When the holiday cheer is in the air, trading desks can get a little quiet. So it might just be worth considering taking a break from trading and joining in on the holiday cheer. After all, there's always another trading day after the holidays. Year-end also brings financial decisions that can affect the market. As we inch closer to the finish line of the year, businesses and individuals alike start to reassess their financial position. This period of financial introspection can have a significant impact on the market, causing fluctuations that can be both a boon and a bane for traders. Let's first talk about businesses. Companies are not just static entities. They are dynamic and constantly evolving. As the year draws to a close, businesses often make strategic decisions about their future. This could involve launching new products, making acquisitions, restructuring, or even announcing dividends. These decisions, while aimed at improving the company's financial health, can cause ripples in the market, affecting the company's stock price and, by extension, the overall market. Now, let's shift our focus to individuals. The end of the year is also a time when many people take a hard look at their personal finances. They may decide to sell off underperforming assets or buy into promising ones, perhaps in an effort to offset capital gains with losses for tax purposes. This surge in buying and selling can lead to increased market volatility. Another key factor to consider is portfolio adjustments. Fund managers, keen on ending the year on a high note, might choose to sell off underperforming stocks and buy high-performing ones. This practice, often termed as window dressing, can lead to artificial inflation or deflation of stock prices, creating an environment of uncertainty for traders. Moreover, tax considerations also come into play. With the goal of minimizing their tax liability, both businesses and individuals might make certain financial moves. These could range from selling losing stocks to offset gains to making charitable donations. Again, these activities can stir the market pot, leading to unpredictability. So, in essence, the end of the year is a time of financial reshuffling. Businesses and individuals are making moves, reshaping their financial landscapes, and these activities can send waves through the market. With so much financial reshuffling going on, the market can become unpredictable. So, is December a definite no-go for trading? Well, it's certainly a month to approach with caution. We've explored how historical performance shows a decrease in market volumes and volatility, often leading to unpredictable price movements. We've debunked the Santa Claus rally myth, highlighting that it's not a reliable trading strategy. Holiday distractions can also cloud judgment and divert attention from the markets, making it hard to stay on top of your trading game. And let's not forget the impact of year-end financial decisions. Many companies and investors adjust their portfolios and strategies, causing further market fluctuations. These factors all underline the importance of careful analysis and thoughtful decision-making in trading. It's not about being scared away by December, but rather understanding its unique dynamics. It's about knowing when to trade and when to step back, analyze, and strategize. Remember, in trading, timing is everything, and December might just be the time for a well-deserved break.